for Friday, October 15th, 2021. We have a kind of a mixed market this morning with very strong digital currencies to the upside. Coin made a new high of 60,985, trading last at 60,520. Gold is down about $27 and silver as well. On what I believe is some economic numbers that are kind of a mixed bag. 1 week they're showing a decline in economic activity, employment. Another week it's showing an increase in inflation, and it's really kind of a meat grinder right now in terms of dealing with the fundamentals. The reality is obviously that the sentiment of the market seems to be that we're going to be moving into a weaker dollar, which is one of the reasons why Bitcoin is becoming such an asset in demand with regards to maintaining some kind of a value, some kind of a intrinsic value, as opposed to the declining value of the US dollar as we continue to print more stimulus. So what we're doing here is basically I am using the VCPMI, which stands for the Variable Changing Price Momentum Indicator, to identify these markets and look for trading opportunities, short-term, intermediate, and long-term. For those that are joining me, I want to welcome you here, and for those that have been watching me all this time, I want to thank you for all your comments, and hopefully you're beginning to understand the contrarian direction, basically, that is sometimes provided by the VCPMI. The Variable Changing Price Momentum Indicator is an instrument that I use that was written in C++ easy language, which identifies the extreme positions in the market as it relates to the supply and demand. And the algorithm uses a structure, very definite structure of 5 pivot points. And within those 5 pivot points, it gives us a structure that identifies the average price and extrapolates the extremes above that average price and the extremes below that average price, which essentially represent the speculation in the market, the extreme speculation in the market. One of the things I want to do here on this segment is to take a look at the weekly reports that we published on Saturday, and actually see the results that we've had so far.
Hello everyone, this is Equity Management Academy with a weekly gold report for October 8, 2021. Summary: the weekly trend momentum of 1778 is bearish. The weekly VCPMI of 1762 is bearish. A close above 1762 stop negates this bearishness neutral. If short, take profit 1741 to 1725. Trading instructions. Weekly trend momentum, 1778 bearish. The gold futures contract closed at 1,757.4. The market closing below the 9-day SMA 1778 is confirmation that the weekly trend momentum is bearish. A close above the 9 SMA would negate the weekly bearish short-term trend to neutral. Strategy: we are coming in with a weekly bearish sentiment, unless it closes above 1778. Weekly price momentum, 1762, bearish. With the market closing below the VC weekly price momentum indicator at 1762, is confirmation that the price momentum is bearish. A close above the VC weekly, it would trigger weekly stops and negate the bearish trend to neutral. Strategy: we are coming in this week with a bearish price momentum, unless it closes above 1762. Weekly price indicator. Exit, longs. Sell 1, 1778. Sell 2, 1799. Exit, shorts. Buy 1, 1741. Buy 2, 1725. Look to take profits on shorts into corrections at the buy 1 and 2 levels of 1741 to 1725, and go long on a weekly reversal stop. If long, use the 1725 level as a stop close only, and good till cancelled order. Look to take profits on longs as we reach the sell 1 and 2 levels of 1778 to 1799 during the week. Strategy: bearish targets are 1741 to 1725 to cover shorts and look for support. Look for reversions from here to unfold back to the mean. A close above 1762 activates the 1778 to 1799 levels of resistance and targets.
it continued to activate short triggers now from the sell to level. So let me just review this, that the market came down into the weekly average price of 1762. It reverted from there after completing the target from the previous signal of 1778. The target was completed, and it reverted up by activating what the VCPMI calls a bullish price momentum. Automatically, when the bullish price momentum is activated, the targets of the sell one level and sell two levels become very active. The reversion occurred with the target completed weekly of 1778 at 5:30 a.m. on the 13th. But as you see here, the weekly signal activated a bullish price momentum, but the daily, it engaged the daily signal as well, and so that it became a more prominent signal. Very strong signal where you had the daily activating a buy signal and a bullish weekly price momentum. The first target was completed on the weekly. So we're looking now for the second target of 1799 to be completed, and it was completed today at 1801. 90 high satisfied and completed the 1799 level. Now from here, from the sell to level, obviously completing the previous pattern, now we're looking for short triggers from here. The market activated a short trigger on the 14th at 1796.90, and when it activates a trigger right away, the target below, the level below, is the first target, and eventually the average price, which is the weekly average price, is the target for the reversion to the mean from the extreme levels above the mean. Now, in terms of mathematical probabilities, when the price activates a short trigger from the sell to level, or the level of resistance here, this level has a 90% probability factor relative to the implied volatility to the mean, which is a 50-50 standard deviation. And that's the mean, 1762, that we pretty much will revert back down if the signal is activated. So what we see here is the market hover around this resistance level, where we begin to see more supply come into the market, and the artificial intelligence tells us that this is the area in red, and that you can potentially experience supply to come into the market. Continues to consolidate, continues to trade below until it begins to activate a more aggressive signal, and it activates a trigger point, another trigger point below the weekly signal of 1799. Our target are the levels below, and so the first target that you see are the daily numbers. Obviously, if we were trading a weekly signal or a monthly signal, the earliest cycles are in the dailies, and those are the targets that you can use if you have multiple positions. The market comes down to the average price. It activates a daily bearish price momentum, continues to come down as expected. It meets the daily by one level, and it gives a false signal at 1789, a buy signal, which is negated by the close below. When you enter the trade, automatically you use the level below or above as your protective level as the most conservative stop. Or you can use a maximum dollar amount or wait for the market to complete the second target, which is 1781. Market came down, activated another buy signal from here, and it was negated once again. And we took this trade earlier, and we got stopped out by the close below. We chose the most conservative stop for our traders in the private trading room. And so this is a perfect example that this is not a perfect science. But we are working with probabilities, and we want to have all of the probabilities on our side when we trade. And so what I'm doing here is I'm showing you how I'm using it to day trade the market by combining the daily signals and the weekly signals. It activated a bearish trigger below B2, which neutralized the daily model. The daily system is neutralized when it closes below 1782 or above the sell 2 level or below the buy 2 level. As the market came down, it activated it picked up the weekly sell 1 level. So now we got a weekly signal from the sell 2, and we got a daily signal. And this level is a 90% probability that upon confirmation of the market, the trigger point, it will gravitate towards the mean of 1762 as the target. And so we see the market coming down, making a low of 1765, not quite coming down to the average price of 1762, and finding buyers at a higher level, which coincides with a 50% Fibonacci retracement of the previous pattern, which basically is the high of that we made back in June to the low that we made. Excuse me. I'm looking at a bigger model here, which incorporates basically the low of 2020 to the recent high that we saw of 2089 in August of last year. And this is the big pattern which gives us the Fibonacci retracement. And what you can see here is that the market comes down to this Fibonacci retracements and activates a golden ratio signal here at 61.8%, which was 1673. And this was made on March of this year. So from 1673 low, we saw a high of 1919, which became the resistance level, or the target, you might say, which began to form this uptrend channel, which we're in. We're in a major uptrend channel in gold. In short term, we are beginning to establish the bottom of a third wave within a bigger pattern, within a bigger wave pattern from the low of March 20 to the obviously high in August of 2089. And that was the first leg. And the second leg that we're looking at is being completed. This is the second leg of the bigger pattern that we saw from the low of March 20 to the high in August. And the market has entered and consolidated and went into a corrective pattern since August of last year. So it's been in this pattern for a year now, completing the second leg of a major five-way pattern that the gold market has established. Within that bigger wave pattern, we are trading also into the second corrective wave, beginning the third wave. And the target for the third wave, obviously, is the resistance of the uptrend channel, which is all the way up to 1963. 1937 was the 23.6% of that Fibonacci retracement. So coming back here to the VCPMI, what you see here very clearly is the AI that tells us whenever the price comes down into that blue level, which is the buy one, buy two, expect a reversion to unfold. And pretty much that's what we are doing here, is reverting and trading now above the support, trend line support, above the weekly average price of 1762, which negated the bearishness, the previous bearishness that we came in with. Let me take a look at the bigger patterns that we are in here. As you can see on the left of the chart, we have the monthly average is 1772, and you can see on the bigger picture as well, the market coming up to 2129, which is the next forward contract in December, corresponding the high that was made in August of 2129.60. But you can see here that it's in a red zone. So automatically when you're trading the VCPMI, you're trading the extreme levels above and below the mean. You want to pay attention to this. As the market came down, supply came into the market all the way down to the area in blue, and it stopped the decline. And what we saw here is a reversion back up from the monthly level, and it completed the monthly patterns on May 31st. It reverted back up above the mean. And here's an example when the price trades around the average or the mean. I say basically to be neutral if you're trading it, because it's going to get choppy. And that's pretty much what we see here. We came down on this signal and completed the target here, obviously into the blue zone, but not quite coming down to that 1572, which is what the annual average price is pretty much indicating. Now, it doesn't necessarily mean that these levels have to be completed. It's telling you that we're in a bearish pattern, but if it does close above 1840 yearly, it would activate a bullish price momentum. Closing above 1772 monthly activates a bullish price momentum. So we get a pretty good idea and a pretty good picture where the market trends are basically relating to each other. And that gives us a clear picture. Like now, the market is on the average price monthly of 1772. It negated the previous bearish signal. And so now the targets of 1823 and 1888 are active for the rest of the month. So it's, even though we came down today, the VCPMI is telling us now, between the daily and the weekly, that the weekly average is 1762, and we came not quite down to 1762, but we came into the support of the trend line at 1764, completed the 50% Fibonacci retracement, and are reverting back above the weekly average, which is bullish. So the target, 1778. Once again, now, 1778 to 1799. These are the weekly areas of distribution of supply. Since it's Friday, obviously the daily numbers are going to change, but it's neutral right now daily by trading below 1781, which is the buy to level. So just to review, it looks like we completed the targets in gold as we came into this week. And I wanted to focus on the gold market because I think coming back down into these levels here, and if we get through either above 1840, looking at the big picture, which will establish a major breakout in gold, or coming back down into that 1740-50 area, which I believe is an area to accumulate aggressively. And I think we're looking for maybe a couple of more weeks before the final bottom is in, or before that could potentially make the annual low of 2021 if it is not already in place, as we recommended in the 360-day analysis that we made when the market came down to 1721. So far, this probability is increasing greatly that this could be the annual lows for 2021. Thank you, my friends, once again for this great opportunity to share this detailed technical analysis of the VCPMI. And I wish you a very, very happy weekend. Have a great weekend, and I'll see you on Monday. You be well.